Right now, it's pretty hard to avoid all the noise about a possible recession. Everyone's talking about the cost of living crisis, inflation's out of control, and you're also being told to hang on to your seat as central banks push up those interest rates all over the world. In this video, I want to strip everything back, keep it simple, and take a look behind the curtain with you. With all this talk of fear, panic, and craziness in the world, I'm going to break down everything you need to know about inflation, interest rates, a possible recession, and most importantly, what I think the average person can do to profit, or at least come out of the other side alive and better off. Because just like the man behind the curtain, once you have an understanding of how some of these things work, I think they become a lot less scary. I don't believe you! First up, let's run through where things are right now. We know that the first half of 2022 has been the worst start to the year in terms of stock market performance since 1970. Doesn't matter which index you look at, it looks grim, and they're even worse for investors who went all in on technology stocks from the Nasdaq. If you started investing over the last couple of years, it's very likely that you're now in the red, but the big question is, should you be worried? Let's deal with that point first. The stock market's a funny thing because we all try to come up with stories to explain why it acted the way it did, saying it went up today because a certain event happened, or saying it went down today because something else happened. The truth is that there's so many factors in play that any kind of predictions are virtually meaningless. While there might be some things which track closely or appear to have a cause and effect, remember that trying to predict the moves of the market is a losing game. Here's a good example, keeping on the theme of the Wizard of Oz. The Tin Man here is like the stock market. He moves from side to side in cycles. For brief periods of time he stood up straight, but then he's nearly fallen over again. And sometimes he does completely fall over. The most important thing in my opinion is knowing that even if the Tin Man does fall over, he will get back up again, and it's pretty common for him to fall over too. If you read up on some of the great investors, they'll explain that the stock market moves in cycles, going through periods of overexcitement, easy money and bull runs on one hand, and then massive downturns, crashes and recessions on the other hand. Timing them is a waste of time, and knowing what part of the cycle we're in is anyone's guess, but knowing that they happen should make you sleep better at night. Now, regardless of where we are in this market cycle right now, let's talk about one of the key driving forces behind the possible recession: inflation and interest rates. These things are linked closely, and the more you understand, the less scary they become. Right now, we're facing a cost of living crisis. You would have seen energy prices soar in your electric and gas bills at home, and the price to fill up your car has reached some crazy highs. The latest figures on inflation are given to us here in the UK by the ONS, and in the US they're provided by the Bureau of Labour Statistics. Using what's known as the Consumer Price Index, they compare the price of things that we buy in any given month to the price that they were just 12 months before, as well as the last month as well. Right now, you'll hear that in the US, their last reading was 8.6%, and for us in the UK, we hit 7.9%. So really simply, let's say that your weekly food shop was $100 or £100 last year. Well, if we use those figures, that means that for the exact same things, you're now paying about $108. That's inflation. By the time this video comes out, we'll also have the latest figures for July. It's not expected to slow down anytime soon, so keep your eyes open for that one. Having too much inflation is a bad thing. That's definitely something we can all agree on, because it has many bad effects for lots of people. If things cost more that we need to buy, like our food, our fuel and our rent, then the money that we would have had left over becomes less and less. So everything else we might have bought might miss out on our business. Whether it was a new car, new clothes or other luxury items, all of these businesses that sell those things might now suffer because we don't have any money left. Also, another issue that happens is if we're worried that prices keep going up, that we're more likely to buy more things now in bulk too, which will then just keep making things worse, as there might be a reduced supply of those things, leading to even greater prices. Do you remember the whole fiasco about toilet rolls? Most central banks aim for around 2% as the right level of inflation, so don't think that having some inflation is bad. It's only bad when it gets to the extremes, either too high or having none at all. Another thing that happens, which is currently all over the news, is that workers demand higher salaries and better wages. In the UK, we're currently seeing workers strike to get pay increases that fairly reflect the new rising cost of living. Remember that if you don't get a pay increase every year in line with inflation, this means that you're actually getting a pay cut in real terms. You've got the same amount of money, but your shopping basket now costs more. This is another thing that also seems to go in cycles. It's called real wage growth. You get paid more than the rate of inflation, and that's considered real wage growth. But if you only get paid at the same rate of inflation or less, then technically your wages are getting lower, even though you might see more money in your pocket. On this graph from 2001 to 2017, you're seeing UK wage growth. Every time the blue line beats the red line, we're getting more in our pocket. and every time that the red line's on top, we're losing money in real terms. Right now, we're seeing a big gap between what we're being paid and the cost of living caused by inflation. So on this chart with the most recent data, you can see how the red line, which is inflation, is beating our wage increases in grey, which is not good at all. To combat all of this, central banks have a job to manage inflation and keep the economy stable, and this is where interest rates come in. As a general rule, when inflation is high, a central bank like the Fed in the US or the Bank of England here in the UK will increase the base rate of interest. Doing this has multiple effects, and it's a really careful balancing act. Over the past decade since the financial crash, we've seen very low interest rates around the world, and those were kept in place to ensure that the economies could grow. Low interest rates mean that there's a huge incentive for businesses to borrow money and savers to spend money. Think of it this way, you can get a really cheap loan which costs you 1% interest, but you can invest that money into your business which can make 20% profit, then it's a no-brainer. And it's the same with mortgages and personal loans too. With a low interest rate, people can buy bigger houses, more expensive cars and take on more debt, knowing that the cost is pretty cheap. More money in the system pushes prices up, creates more demand and drives the economy forward, but then if you go too far, like we've just seen over the past 2 years, with putting too much money into the system, you end up with some negative effects too. Most recently, house prices have gone through the roof as people wanted to move out of cities into larger homes, used car prices have soared as supply chain issues stopped new ones from being made, and so many new companies on the stock market were given huge amounts of cash and massive valuations. In fact, last year in 2021, there was a record number of new companies on the stock market who IPO'd. Over 1,000 companies went public, which is more than double the year before, which was already a record in itself. I have a feeling that it might be a while before we see that thing happen again. Right now, interest rates are on the rise as everything we've just spoken about goes in the opposite direction. With a higher interest rate, money becomes more expensive to borrow for a business, mortgages become more expensive so you might not be able to get that bigger house, and savers have more of an incentive to keep their money in cash rather than spend it. All this does is help cool off the demand, which should over a bit of time reduce the cost and the effects of inflation, as then we go back to the simple concept of supply and demand. If we buy less stuff, spend less money, prices won't inflate so much. But then of course we could end up going the other way, causing the markets to crash, and we could enter into a recession. Now, a recession is defined by having 2 quarters back to back where our GDP growth is negative. GDP stands for gross domestic product, and in simple terms, it's the value of all the goods and services combined for the year. Basically everything we produce as a country all added up and put in one place. For some context, the US currently has a GDP of $20 trillion and the UK is $2.7 trillion. Poor us, we're only very small. If our GDP growth slows down, this of course is a problem. An economy that doesn't grow brings in less money to spend on public services, doesn't create jobs, and is by all means not a great place to be. Most of us will remember the last recession after the financial crash and the years of the government austerity that followed. It wasn't a fun place to be. Right now, the threat of a recession is high, and as for the last quarter, January through to March of this year, the economy shrank. In the US, it reduced by 1.6%, and there were fears that for the next 3 months, we'll see further reductions that will then mean that the US falls into a technical recession. In the UK, we're not quite there yet as our economy grew 0.8% last quarter, but we really need to pay attention to the US figure as the largest economy in the world is the one to focus on. Lots of commentators are speaking about numbers from the Atlanta branch of the Federal Reserve who have their own model called GDP Now, which looks to suggest that we're already in a recession once those numbers get confirmed. All of this, however, is just technical and data driven. But what does it really mean for us, and what should we do to prepare as investors and just generally in our lives? We need to go back to basics and get our houses in order and give ourselves a good financial health once over. Like in The Wizard of Oz, if we're a tin man, we need to get ourselves a heart. If we're a scarecrow, we need to get a brain. And if we're a scared lion, we need some courage. I don't know where I'm going with this example, bear with me, I need to tie this one all together. One sec. Okay, in short, imagine that all of the characters are investors and the yellow brick road is the path that they want to get on. The journey that they're going on is always going to have obstacles like flying monkeys and witches. Again, I really need to figure out how I can tie in the flying monkeys with personal finance. Okay, I've got it. Here's the story. If we're headed for a recession, that's fine. We know that they're rare and they won't happen too often. On average, they last a couple of years, but we also know that at the end of the yellow brick road, there is light at the end of the tunnel. The last thing we want to do is sell everything and give up now. After all, we're on the way to see the wizard and we need to keep putting one foot in front of the other. If we're lacking courage like the lion, we need to remind ourselves that for our regular long-term investors, by making sure that we keep investing even during market downturns, this is where the real money is made. Remember that every time someone sells a stock, there is a buyer on the other end. There's no such thing as a market sell-off where only sellers operate. There has to be buyers too. The buyers get rewarded in that long run. By dollar cost averaging into low cost index funds, the money that goes in now during those market downturns will compound massively when we look back in the years to come. However, be warned, don't be a scarecrow and forget your brain. If you buy stocks that are just cheap because they've hit new 52-week lows, then you might find yourself trying to catch a falling knife. Also, trying to jump around the market and time different sectors is probably going to make you very poor and very stressed. Jumping from growth stocks to value stocks, from oil to gold because you think one's going to go up in the short term and you're trying to find some safety is most likely going to end up badly. The biggest driver of prices in the stock market in the short term is human psychology and sentiment. The financials get pushed to the side. Almost every serious investor who's done this for a long time will tell you to stick with the plan. Only as long as that plan doesn't involve meme stocks, but hey, it's your money. Finally, you're going to need a heart. This bit isn't about the investing, it's about making sure that the rest of your finances are in order. If you can invest every month or whenever you get paid, that's great. But during a recession, you might have to cut back. You're going to need to work out what's best to do. Paying off that high interest credit card debt and reducing your outgoings might be a better investment in the short term before you worry about investing if it's a choice between one or the other. This one's personal to you and your own situation. Saving up for a house might be better now than trying to invest in stocks, but make the decision that's best for you. After all, there'll be another bull market run or positive cycle in the market where we can all look like geniuses and share our portfolios on YouTube with massive green arrows everywhere. Focus on the long term, focus on compounding, and focus on the practice of making investing as simple as putting one foot in front of the other. Just like the wizard himself, the fear of a recession and the fear of losses are never quite as bad as the actual thing when we look back with hindsight. Even if everyone's screaming sell and Kansas has tornadoes, there will be better days ahead. If you want to learn more about the stock market crashes that have happened in the past, and I've actually done a video about this talking about the dot-com bubble and how it compares to 2022, there's a lot to learn and you might end up feeling better about things right now. I'll leave you now to enjoy that. The wizard's calling me. It's my shift. Happy investing.